Welcome back to the Daily Nugget. Property Insights, one topic, 20 minutes or less. Myself, Lawrence Lotze, and joined by James Blair, a financial advisor. And James, we've covered off inflation and media impact on investments in previous Daily Nuggets. And what I wanted to cover off today was, what should you do with your investment portfolio right now with everything that we're seeing, we're hearing, and the impact? What is sort of the guide points of where to go? Grow, sell, keep? Hold on, white knuckle, as they say. What's your thoughts around investment portfolio or getting into it at the moment?
Never, ever sell, Lawrence. Never sell. It doesn't matter. If there's somebody outside your front door saying, we're taking the house, keep the door locked, don't open it. No, but in all seriousness, that's a question we're getting asked a lot at the moment with how much the market has dropped in terms of the share market at the moment, with how much interest rates are going up, with maybe a little bit of plateauing or only a slight softening in the property market. There's questions around what should I do, and obviously the inflation numbers as well. I hate sitting on the fence for multiple reasons, Lawrence. One reason is because it's slightly uncomfortable sitting on a fence, but it really does depend on your situation. The age-old saying around, I've got $100,000, where should I invest it? It depends on, do you have personal debt? Do you want to buy a house? Are you planning for retirement? Now I've got that out of the way. The main thing to bring it back to is when you made these investments in the first place, assuming there was kind of an investment to start with there, whether it was property or shares or crypto or whatever it might be, why did you make that investment? People, unless people don't invest in assets because they're just wanting the asset to go up in value and never really plan to sell it. There's always a reason behind it. Maybe they're wanting financial freedom. Maybe they're wanting to help their kids in the future. Maybe they want to use it to travel, whatever it might be. You've got to link back your current investments and the noise around the market and what's happening at the moment to what are your goals and what you are trying to achieve. I said in a previous episode, markets go in cycles. If things were good forever, everybody would be invested in the highest risk portfolios because everyone would want huge returns. We know that generally speaking, there's a 7-year cycle. There's 3 good years. There's 3 kind of boring years, and there's 1 bad year. Now, we're very, very overdue for that bad year. We haven't had 12 months of negative returns since 2008. So that period coming is not necessarily a bad thing at all, which maybe you can ask me about in a second. But the most important thing is to firstly make sure you can kind of survive in terms of rising interest rates. And I mean, if you're going to be foreclosed, you probably need to do something. But whenever the markets are down, ideally you're buying whatever that might be, because that's a discount, that's an opportunity. But most importantly, linking it to your plan and going, doesn't matter what happens in the short term, because if I'm in a well-diversified or a sound investment, I know over the long term it will increase in value.
That is so true. I mean, think of human psychology, right? We only go and buy clothes, not we only, but when there's a sale on in New Zealand at the warehouse or Briscoe's, there's always a sale. That's the only time we buy there. So
if you buy from Briscoe's during the week, you're a sucker.
Yeah, right. Pretty much. So why wouldn't you, as James says, as long as you can make it through and survive, right? I'm not saying go and buy something and then you're out on your arse a week later, right? As long as you can survive, why wouldn't you go and look in a sale time period and purchase certain items from your investment strategy? As long as your advisor is advised in the right path and where you're going from that. But that's the sort of stuff where people get so worried and scared. They're like, hey, it's the biggest, in simple terms, it's the biggest sell-off of property and shares that we've seen since 2008, since the GFC. And it's like, yes, it is. But doesn't mean I don't have to get on it. Doesn't mean I'm not going to go and jump on board and buy at 30% or 40% discount if I can afford it, right? We are seeing the 1% of some investments totally falling over, right? I know people listening or watching is going to throw it at me going, hey, did none of you guys watch Luna? And what happened to Luna that went from 100% to 1% or 0% value in 7 days? Yes, it happened. That's also digital currency, which you have to accept you have that risk from day one, irrespective if it's if it's a coin, a currency, a token, or whatever it is. That is the risk you take on that. But on all the other side of things, there's discounted options to be happen, and I don't see any run-ins at the moment, unless James sees it, that we've seen as critical state as we saw in 2008 that major companies are going to fall over. We've got a hard time now, but I'm not seeing any of that major flags that we're going to see, Lehman Brothers examples falling over at the moment in the current market.
Yeah, it's tricky, Lawrence, right? Like you'll everyone's an expert in hindsight, and when you're kind of trying to predict going forward, it can be really, really tricky. I should preface on there as well, though, that I say never sell. I think it is a good time to reflect on kind of coming back to the plan and your goals and your time frame. Like if you're looking to buy a house in 6 months and you've got your money in crypto or shares or something like that, you can't expect it to recover in 6 months' time. That's not a guarantee. So you've got two options in that kind of situation. One is you pull the pin, take the hit now, if you still want to buy the place. The second is ride it out and hope there's some sort of recovery over 6 months. Or the third is you delay your plans until that correction happens. The other piece in terms of maybe you should be doing something is if you've gone, I got on like the sharesies or the property hype train, and I've realized I'm actually not that comfortable with volatility and it's really stressing me out and it's not good for my mental health. Then there's probably a discussion around risk profile, and you haven't had a good discussion around the actual risk you can tolerate as an investor, because this will happen again, and it will happen worse than what we've seen at the moment, because this compared to all-time lows is very little.
Yep. Awesome. Thanks for that, James. And just to anyone at the moment, the roulette table or the craps table is not an investment strategy. Taking your $1,000 or your $10,000 and thinking you can go there and throw it on a table and double and triple your money is definitely not part of the investment strategy. So make sure that you don't go out and doing those, right? I can imagine you've seen a few examples of that, James, across your time.
The experienced investors at Sky City or with the TAB, they'll always like to tell me about their wins and never their losses.
Yeah, pretty much. Awesome. Thanks so much for James for coming on to the Daily Nugget Property Insights. One topic, 20 minutes or less. And as always, hope to see you tomorrow.